Worried about inflation? Here's how your investments did in the 1970s. This is a Market Watch report, which we're going to dive into deeper. You can see right here, this is from National Association of Real Estate Investment Trust, Kenneth French over at Dartmouth, New York University Stern School. You can just see they're compiling this net of inflation. And you'll see energy stocks did well. 10-year treasuries did poorly. There should be a huge asterisk, which we'll go into here. S&P 500 didn't do great. T-bills basically broke even. So remember, after inflation, 10-year treasury was down over a third of your capital, your real purchasing power lost. A huge issue with this. This is from December 1971 to December of 1981. The reason being because that's when the National Association of Real Estate Investment Trusts started their data set. Now, Brett, who wrote this, which I'm a big fan of this, he talks about right here, the key standout is you really didn't want to own treasury bonds. Again, he should have put an asterisk on here. The near 40% loss of purchasing power over 10 years is somewhat notional. Is derived by the compound annual returns on a 10-year treasury compiled by the New York School, divided by the CPI, but it tells a story nonetheless. Holding them costs you a lot of money. All right, maybe. So I want to, let's just dive into my spreadsheet here. All right, so here's real treasury returns. Here's the 10-year treasury going back to 1926, and here's the inflation rate. So we're going to look at real treasury returns. All right, we're going to start in 1971. That's what the 10-year bond was doing. Now, we're just doing this calendar year to calendar year, my friends. We're not doing December to December. We're doing calendar year, calendar year. All right, so you bought a 10-year treasury bond. You got 6.2% locked in for 10 years. Locked in for 10 years. So real treasury, this is why I get real nervous about people citing the 4% rule and bonds and all that, because there's two different things happening here. A 10-year treasury bond is an illiquid asset. It does not, it stays fixed, i.e. the 6.2% is what you got this whole time right here from 1971 to the end of 1980, well, basically really, and end of 1980 for 10 years, but still. You got 6.2% fixed each and every year. Now, here's your return. You got we know for a fact, 10-year treasury, you're going to start with $100,000. You're going to get $62,000 back with principal plus interest. We know that for a fact, all right? Now, on the other hand, inflation over that time was at 89%. So, we're not even compounding or anything. We're just, because you can't compound interest on bonds anyway, but we're not going to compound interest on inflation anyhow. But you do compound interest on inflation, but you don't on fixed income. So we know for a fact this would have been your inflation had eaten up 20%, 27% of your purchasing power. That is correct. So Brett, using these stuff is correct. Now, again, I wasn't adjusting for compounding. So if you do that, that's where you got 38%. I get it. So we had a 62% rate of return on treasuries, and we had an 89% inflation rate, not compounded. And as such, you lost over a third of your principal for purchasing power. I get that. The problem, though, my friends, this is why the whole thing with the 4% rule is, and this right here, is that how many people actually bought a 10-year treasury back then? Not very many people. So the only reason you buy a 10-year treasury, it was an illiquid asset. You're holding it for 10 years to get the income. If you did that, yeah, you lost money. No other way around that. The vast majority of people don't have the money or resources to buy individual bonds like that. They just don't, and they didn't back then. And remember, though, my whole issue, the 4% rule, was the assumption that, there's lots of assumptions, but that you could trade these 10-year treasuries like they're short-term bonds. They're not. They're fixed. You're locking them as a fixed rate. So the thing with the 4% rule, frankly, is that he says, 6.2 is what you got in 1971. 6% is what you got in 1972. I'm like, no, it's not. You didn't get that by recycling 10-year treasury bonds. You didn't. You had to have liquidity. And so this is the other side of that thing. This is saying, you locked in a 10-year treasury bond at 6.2% for the next 10 years. Now, some people did, sure. But you didn't. I guarantee you were not buying 10-year treasury bonds. I guarantee you're not doing it right now either. You're buying mutual funds, which have, like I said on the Putnam Income Fund, had 1,400 bonds in there. It's a turnover 1,000%. They're cycling through bonds all the time. So it's not what you got, man. So net of inflation, if we take in a recycling of the bonds, is what I mean by that is you have 10-year treasuries being recycled all the time because you have a mutual fund like PIMCO or the Putnam Bond Fund. You did not just get 27%. You didn't. And we can just simply look to any kind of bond income fund to see what it did, which I just did not too long ago. So let's look at it again. This is the Putnam Bond Fund. Again, it's the longest bond fund I could find. So we go back to 1971 to 1981. We start with $100,000. Oops, what happened here? Let's go here. Oops, we'll get rid of this blank zero. I'm using my man Daniel Kulibert's spreadsheet over at 55E as an echo, 55E.co. All right, so we're going to put $100,000 in. We're not taking any money out. At the end of 1981, this guy's worth $182,000. $182,000 at the end of 1981. So we made 82% on our money. And if we go back to our spreadsheet, inflation is 89%. So we've lost basically 10%. That's not the same as losing 38%. You know why? Because these bonds are being cycled. Look, I mean, I cannot stress this enough. So here we're up 8%, but with inflation, we were down 2.3. Here we're down, so we got killed in these 3 years right here. Destroyed, utterly destroyed net of inflation, all right? Here we got destroyed. There we did not. Right here, we made money. Right here, we made money. So we got destroyed net of inflation a couple of these years, but by and large, we came out a little, we lost money, but not to the same 38%. Secondly, let's just use, okay, let's say that. Now let's just use something like the Wellesley Fund, just for example. This is why I just worry that people are just saying, well, what if? So the Wellesley Fund, we had 182,000. Is that the Wellesley? Yeah. Right there, 230,000 bucks in the Wellesley. All right, so we did not lose money in the Wellesley. So if we go back to this chart right here, if we had the Wellesley, we didn't lose anything, which is why you need to have some stocks, by the way. But but isn't that interesting? Because S&P 500 purportedly was down 16%. And it was, yes. See, here's where it gets a little bit dicey. Because if you look at the S&P 500, the return was 99.2%, your overall return for that time frame from 1971 to 1981. However, your average rate of return was 0.93%, all right? However, if you take your trusty calculator and you do with actual cash flows, i.e., I was up 10%, down 16, up 20, down 21, down 38. We actually were down to 87,000. We lost, 12.5% on the S&P 500 if you actually calculate it year over year over year. It's very interesting how this stuff works. So right about, he's got a little bit more than I do. But anyway, because he's using a little bit different date. So if you calculate year over year over year, the S&P 500 from 1971 to 1981 was down, we'll just say 13%. Interesting, huh? So let's again, but then we look at a portfolio like the Wellesley was at was up, not too shabby. The Wellesley was up. The PIMCO bond fund was a little bit down. The S&P 500 was a little bit down, not huge amounts, a little bit down. All right, but if you had other fund, and then we just go to gold-fashioned Wellington fund. I mean, just cheese, Louise, and blue cheese. This is why I'm just saying it's like there's not. I worry people are going to look. There's no place to run. Wellington from 1971 to 1981 was up to 195,000. So Wellington fund basically broke even. All right, now if you got to factor taxes in there, you lost money. I guarantee you did. Where I'm going with this, so this is not nearly as bad as this looks like. I mean, they're doing from December 1971 to December of 1981. That's a pretty bad time frame, without question. That's a bad time frame to investing. So it was in January of 2000. It was actually March of 2000, but still, there are some bad times. But it's not nearly as bad as what this looks like because you did not buy a 10-year treasury. You didn't, man. And if you had enough money to last, if you didn't run out of money and you could last until 1982, man, the world was your oyster. Don't get so caught up in this stuff. I'm telling you, it ain't worth it. It ain't worth it. Just get a diversified portfolio, recognizing there is no place to hide. I mean, it is what it is. And then what do you do with this? Do you start buying energy stocks? I mean, no. Just keep it diversified, keep cash on the side, and make sure your debt's paid off. All right. Love your thoughts. Thanks now.